Alright, this is gonna be crazy. Let's strap in for it. So yesterday, Federal Reserve just announced the latest rate cut, and as expected, they cut by 25 basis points. Now, this was basically the highest confidence rate cut going into this year, right? Everyone expected them to cut 25 basis points. So nothing too surprising, right? However, the market reacted really badly. So what we saw was that the market actually fell by overall close to 3%. In fact, Nasdaq fell by 3.6%, and my own portfolio fell by close to 5%. So what exactly happened? What went wrong over here? So you can see that going into this round, the FOMC meeting, right? The expectation is overwhelmingly positive, right? Over 93% in confidence that they're going to cut by 25 basis points. And that's what exactly happened in the projection yesterday, okay? However, there was a kicker in the details, okay? So along with the rate cut, the Federal Reserve will always release something called the Summary of Economic Projections over here, right? And this basically tells you what do they think further into the future, and that is where everything changed. Okay, so what has changed over here? As you see, this was basically the Federal Reserve Fed funds rate compared to what they announced in September, right? So for 2024, it's pretty much the same. We're going to cut by 25 basis points, so they expect it to be about 4.4%. But going into 2025, that's where the difference, right? So previously in September, they actually thought that they will cut by a full 1%. So that will be equal to 4 rate cuts. But the latest projection only put it at 3.9 or close to 4%. That means the Federal Reserve has sort of reduced the number of rate cuts for next year from 4 to just 2, right? Just 2 rate cuts, and the market did not like this. Now, the Federal Reserve gave reasons why they did that, right? It's because when they look at some of the economic data, for example, when they look at unemployment rate, it actually has been slowly increasing over the last few months. And also the index that they have been watching, which is the PCE, which basically represent inflation, has not come down to the expected 2% as they wanted, right? So these are the reasons that they mentioned. And the important point here is that, number one, they don't think inflation is coming down fast enough, right? They want to aim for 2%, but it is not at 2% yet. So therefore, they are not going to cut 4 times next year instead of 2. Right, and they also observe that labor market, right, employment and also payroll gains has also slowed down. And last but not least, really unemployment rate increasing really gets them very worried, because that is basically their mandate, right? Their mandate is to cool inflation, maximum employment rate, right? So this is what has prompted Jerome Powell to do so. But the question I want to ask is, if they feel that, hey, this is not a good time to do it, right? Inflation is still running high, unemployment is increasing, why do they even cut rates at all, right? So they say that, it is pretty much them stopping and not wanting to crash the employment market. But I think the truth over here is that because they have already started the rate cut process, right? So if they were to back off right now, it will really impact the market confidence over here. So this is something that I don't think they want to do, and they don't want to create a mess out of it. So therefore, they're still going to cut, but they tell you they're going to cut slower than expected, right? So over here, if you look at it, if we compare the September rate cuts and the December rate cuts, this is another way of looking at it. So what we do here is this is called the dot plot. So basically, every governor in the Federal Reserve, in case you're not aware, the Federal Reserve is not just Jerome Powell. There's a group of them. I think there's like 12 or 13 of them, right? And they each put in their dots to represent where they think the Federal Reserve Fed funds rate should be by that year, right? So you can see in September, basically, there was a bit of variance, but right now, pretty much everybody is aligned already. However, going to next year, 2025, back in September, they pretty much expected a lower position, okay? But now it's actually higher. However, I think what the market is missing here is that if you look into the longer term, actually there isn't too much of a change. Basically, the overall consensus is still that we're going to balance out at about 3% or maybe slightly less than that. So I think that is the blessing in disguise, is that yes, while they're going to slow down the rate cut in the near term, but the longer term rate cut seems to be consistent over here. Right, so this is one of the key points that was mentioned in terms of their policy adjustment, and he mentioned that there is no preset cost for the rate change. So all their future actions, right, will be data dependent. So it really depends on how the market is going to perform, what are the information you're going to receive. But I believe they're still going to continue the rate cut just as they mentioned in the dot plot going forward. And because there's going to be another factor coming in January next year, and that will be Donald Trump, right? And I think Donald Trump is very much in favor of more aggressive and further rate cut to boost the economy. Now, will that happen or not? We're not sure. It's pretty clear that Jerome Powell aren't the best friend with Donald Trump over here. So will he change out the head of Federal Reserve and put in another person so that the rate cut can continue, right? This is still to be seen. But I think as an investor, you should look at this with a bit of zen and calm, right? If you're panicking, right, just because your portfolio fluctuated 4 or 5% yesterday, you should be asking yourself, why is that the case, right? I would say right now, if you're a long-term investor, this might be one of the best time for you to go out there and look for those good businesses, right, that are selling well, that are selling cheap. And it's also a good time for you to look at your portfolio and say, hey, have I over-leveraged my position, right? If such a 5% drop makes you very worried, probably your portfolio might be over-leveraged, okay? Right, so overall, I think this is a good pullback in the market, right? We do expect a bull market, right, to have jumping steps, right? They will go up, it will come down, it will go up and come down. But the important thing is it will generally trend higher. So this is definitely healthy. I really welcome this. So even though I saw my own portfolio fell by 5%, I think this is well worth it. The important thing now is what are the best companies you can look out for, okay? And if you want to know what are the companies that I am personally looking at, check out my online community, Stock Market Genius. I'll put the link in the description. Okay, so guys, I hope you all learned a lot from this session. Do you agree what the Federal Reserve is doing? And are you confident in investing? All right, put down in the comments. I would love to engage you guys. All right, and that's all I have. I'll see you in the next one. Bye-bye.